Your bank did not randomly choose your mortgage rate. The dealership did not invent your car loan rate. And your retirement account did not fall in 2022 because the market was just having a bad year. All of those things were connected to one invisible machine most people never study: the bond market. A market worth more than $145 trillion. And once you understand how it works, money stops looking random. It starts looking connected. Before we break this down, hit like and subscribe, because this is one of the most important financial lessons most people never get. Bonds sound boring, but bonds quietly control the price of money. And when the price of money changes, your mortgage, your savings, your retirement, your job market, and even the stock market change with it. A bond is simple. It is a loan. A government needs money. A company needs money. A city needs money. Instead of borrowing from a bank, they borrow from investors. You give them money today. In return, they promise to pay interest along the way and give your original money back on a specific future date. The money you lend is called the principal. The interest payment is called the coupon. The repayment date is called maturity. That is the whole instrument. A bond is basically a written promise. Lend me money now. I will pay you interest. Then I will return your principal later. Simple idea, massive consequences. Because bonds are not powerful because they are complicated. They are powerful because they operate at enormous scale. Governments borrow through bonds. Corporations borrow through bonds. Cities borrow through bonds. Mortgage markets are connected to bonds. Banks price loans using bonds. Pension funds hold bonds. Insurance companies depend on bonds. And retirement accounts are filled with bond funds most people never fully understand. So the bond market is not just something rich investors talk about. It is the hidden machinery underneath everyday financial life. There is one rule you must understand. When interest rates rise, the price of existing bonds falls. When interest rates fall, the price of existing bonds rises. Rates and bond prices move in opposite directions every time. Here's why. Imagine Sarah buys a $1,000 bond paying 3%. That bond gives her $30 a year. A few months later, new bonds are issued paying 5%. Now, investors can put the same $1,000 into a new bond and receive $50 a year. So if Sarah wants to sell her old bond, nobody wants to pay full price. Why would they pay $1,000 for $30 of income when a new bond gives them $50? The only way Sarah can sell is by lowering the price until the old bond becomes attractive again. The bond itself did not change. The coupon is still $30. The maturity date is still the same. The promise is still there. But the world around it changed. New bonds pay more. So, old bonds become less valuable. That single rule explains some of the biggest financial shocks of the last few years, and the first place most people feel it is the mortgage market. The most important bond in America is the 10-year U.S. Treasury. When a bank prices a 30-year mortgage rate, it doesn't pull the number from thin air. It looks at the 10-year Treasury, because the Treasury is considered one of the safest loans in the world. If investors can lend money to the U.S. government for around 10 years and earn roughly 4.5%, a bank has to ask a simple question. Why would we lend money to a regular household for 30 years unless we get paid more? A household can lose income. A borrower can default. A home can fall in value. A mortgage can be refinanced early. So the bank adds extra yield to compensate for the extra risk. That's why mortgage rates usually sit above the 10-year Treasury yield. Now, watch how this turns into real money. Let's use a buyer named Marcus. Marcus wants to buy a home. He needs a $400,000 30-year fixed mortgage. At a 6.43% mortgage rate, his monthly principal and interest payment is about $2,510. That's already a serious payment. But now imagine the bond market moves. The 10-year Treasury rises by half a percentage point. Not a crash, not a financial panic, just a normal move in the bond market. If Marcus's mortgage rate rises from 6.43% to 6.93%, his monthly payment becomes about $2,642. That's about $133 more every month. Over 30 years, that half point costs him roughly $47,700. Same house, same borrower, same income, same down payment, but the bond market shifted, and Marcus's mortgage became almost $48,000 more expensive. Now push the rate up by a full percentage point. If the mortgage rate moves from 6.43% to 7.43%, the payment becomes about $2,778 per month. That's around $268 more every month. Over the full life of the loan, Marcus pays about $96,400. That's the power of 1 percentage point. A number moving in a market Marcus never traded can quietly add almost 6 figures to his cost of home ownership. This is why understanding bonds matters, not because bonds are exciting, because bonds price the money you borrow. Now compare two different moments in history. In January 2021, the 30-year fixed mortgage rate hit 2.65%. On a $400,000 loan, the monthly payment would have been about $1,612. In October 2023, the same mortgage rate reached 7.78%. That same $400,000 loan would cost about $2,877 per month. The difference is roughly $1,265 every month. Over 30 years, that gap is about $455,000. Same loan, same home price, same buyer. The only thing that changed was the price of money, and the price of money comes from the bond market. That's how an invisible market can hand a family a $500,000 difference without ever sending an invoice.
Now, let's move to retirement. For decades, people were taught one simple idea. When you were young, own more stocks. As you get older, own more bonds. Stocks grow wealth. Bonds protect wealth. That thinking created the classic 60-40 portfolio, 60% stocks, 40% bonds. The stock side was supposed to create growth. The bond side was supposed to provide stability. For a long time, that made sense. But in 2022, millions of investors discovered something painful. Bonds can fall too, and sometimes they fall at the exact moment people expect protection. The Federal Reserve raised interest rates aggressively to fight inflation. Remember the rule: when rates rise, existing bond prices fall. So, as rates surged, bond funds dropped. At the same time, stocks fell because higher rates made borrowing more expensive and future profits less valuable. The result was brutal. The S&P 500 fell hard. The broad U.S. bond market had one of its worst years ever. A balanced investor opened a retirement statement and saw something they were not prepared for. Stocks were down, bonds were down. The so-called safe side was bleeding at the same time as the risky side. The problem was not that bonds are useless. The problem was that many investors misunderstood the kind of risk they owned. A short-term Treasury bill is very different from a 30-year bond fund. An individual bond held to maturity is not the same as a bond ETF. A government bond is not the same as a high-yield corporate bond. And a low-duration fund does not behave like a long-duration fund. The word bond makes everything sound safe, but the details decide the risk. The most important detail is duration. Duration measures how sensitive a bond or bond fund is to interest rate changes. A simple way to think about it is this: if a bond fund has a duration of 6, a 1 percentage point rise in rates can reduce its price by about 6%. If the duration is 15, that same rate move can create a loss of roughly 15%. Now, imagine a retiree named Linda. Linda has $500,000 in a bond fund she believes is conservative. If the fund has a duration of 6, a 1-point rise in rates could cost her around $30,000 on paper. If the fund has a duration of 15, the same rate move could cost around $75,000. Same investor, same amount of money, same interest rate change, but a completely different result. That is why duration matters. It's not a technical footnote, it's the difference between a small hit and a serious loss. And most investors who own bond funds have never checked the number. They saw the word bond, they assumed safety. Then the market taught them the missing lesson. Before we go deeper, hit like if this is making bonds finally click. And subscribe if you want finance explained in plain English, without hype, panic, or confusion. Also comment bonds below if you have ever owned a bond fund without knowing its duration. Now, there's another distinction people miss. Individual bonds and bond funds are not the same. If you buy an individual U.S. Treasury and hold it to maturity, daily price swings may not matter much. The market price can fall, your statement can show a lower value, but if the government pays as promised and you hold until the end, you collect the interest and receive the principal back. That's why some investors use individual bonds for specific future needs. They match the maturity date to the year they need the cash. A bond fund works differently. A fund does not have one final maturity date. It owns a basket of bonds. As some bonds mature, the fund buys new ones. The basket is repriced every day. When rates rise, losses appear on the statement. And because the fund keeps rolling into new bonds, there's no single date where all of your original principal simply returns. That doesn't make bond funds bad. They can be useful. They can provide diversification. They can create income. They can simplify portfolio construction. But they're not risk-free storage containers. They're portfolios exposed to interest rate risk. The next layer is credit risk. Government bonds are considered very safe because the U.S. government can tax, borrow, and create dollars to meet its obligations in its own currency. Companies don't have that power. A company can miss payments. A company can get downgraded. A company can go bankrupt. So when corporations issue bonds, investors demand higher yields. That extra yield above treasuries is called a spread. If a treasury pays 4.5% and a risky corporate bond pays 8%, investors are demanding an extra 3.5 percentage points to accept the additional danger. That spread is more than a number, it's a fear gauge. When investors feel calm, spreads stay narrow. They don't need much extra reward to lend to companies. When fear rises, spreads widen. The market starts demanding more compensation. More compensation usually means more concern. Concern about defaults, concern about layoffs, concern about weak cash flow, concern about companies refinancing debt at higher rates. This is why the bond market often spots stress before the headlines do. A company may still look healthy on the surface, the stock may still trade actively, executives may still sound confident, but if the company's bonds are dropping and yields are rising, the bond market may be warning that lenders are getting nervous. Stocks often sell the dream. Bonds demand repayment. That's why credit spreads matter. They show how expensive survival has become for companies. When borrowing costs rise, businesses change behavior. Expansion slows. Hiring freezes. Projects get delayed. Debts becomes harder to refinance. Margins get squeezed. And sometimes workers lose jobs. That's how the bond market reaches the labor market, not through a headline, through the cost of capital. Now, connect bonds to stocks. Stocks and bonds compete for investor dollars. Every investor is asking the same question: how much return am I getting for the risk I'm taking? When the 10-year Treasury pays 1%, stocks look attractive because the safe alternative pays almost nothing. Even a modest stock return seems worth the risk. But when the 10-year Treasury pays 4.5% or 5%, the decision changes.
If investors can earn a solid yield from the U.S. government, they become more selective about stocks. A risky stock now has to offer a much better expected return. This gap is called the equity risk premium. It is the extra reward investors expect from stocks compared with safer government bonds. If stocks are expected to return 7% and the 10-year Treasury pays 4.5%, the premium is about 2.5 percentage points. That is the reward for taking stock market risk. As bond yields rise, that reward gets smaller. When it gets too small, investors start adjusting. Some reduce stock exposure. Some move into treasuries. Some demand lower stock prices before buying. That is one reason high-growth stocks can suffer when interest rates rise. A company promising big profits far in the future becomes less valuable when investors can earn a decent return safely today. The bond market does not just price loans, it also prices imagination. The higher the risk-free rate, the less investors are willing to pay for distant promises. That is why the market environment changed so dramatically after the low-rate years. When money was nearly free, future growth looked extremely valuable. When rates jumped, investors suddenly cared more about profits, cash flow, debt, and valuation. The story changed because the discount rate changed, and that discount rate begins in the bond market. Now we need to talk about the yield curve. The yield curve is a chart of Treasury yields across different maturities. Short-term bills sit on one side, long-term bonds sit on the other. In a normal environment, longer bonds usually pay more. That makes sense. If you lend money for 30 years, you want more compensation than if you lend for 3 months. More time means more uncertainty, more inflation risk, more opportunity cost. That extra compensation is called the term premium. So a normal yield curve slopes upward. Short rates are lower, long rates are higher. But sometimes the curve inverts. Short-term yields rise above long-term yields. A 2-year Treasury may pay more than a 10-year Treasury. A 3-month Treasury may pay more than a 10-year Treasury. When that happens, the bond market is usually sending a serious message. Investors expect future rates to fall, and rates usually fall when the economy slows enough for the Federal Reserve to cut. That is why an inverted yield curve is one of the most watched recession indicators in finance. It doesn't predict the exact date, it doesn't guarantee the size of the slowdown, but historically, it has been one of the strongest warning signals that economic pressure is building. The bond market doesn't need dramatic language. Prices do the talking, and when the yield curve inverts, those prices are saying the future may be weaker than the present. Now let's bring this to your cash, because bonds also affect the money sitting in the bank. The national average savings account pays around 0.38%. That means $50,000 in a typical savings account earns about $190 per year. Not per month, per year. Meanwhile, 3-month Treasury bills recently yielded around 3.7%. That same $50,000 in T-bills would earn around $1,855 per year before taxes. Same principle, very low credit risk, very different income. Over 5 years, the difference can reach about $8,325. And Treasury interest is exempt from state and local income tax, which makes the gap even more meaningful in high-tax states. High-yield savings accounts can offer far more than traditional banks. The point is not that every person needs to buy T-bills. The point is that cash deserves attention. Emergency money needs safety. It also needs access. But once those two needs are handled, lazy cash becomes expensive.
If one institution pays almost nothing, while similar safe options pay several times more, the difference is not magic, it is spread. And if you never compare rates, the bank keeps that spread. There are also Series I savings bonds. I bonds are issued by the U.S. Treasury and adjust with inflation. They have purchase limits, they have rules. They are not perfect for every situation, but they show the same lesson again. When you understand bonds, you see more choices. You stop treating the local savings account as the only default. You stop assuming every bond fund is automatically safe. You stop thinking mortgage rates are random. You stop watching stocks without looking at interest rates. And you start asking better questions. How much yield am I receiving?
How long is my money locked up? How sensitive is this investment to rate changes? Who is borrowing the money? Could the borrower fail? When do I need access to the cash? Am I being paid enough for the risk? That is real financial literacy, not complicated jargon, clear trade-offs. So, here's the practical playbook. First, check the duration of any bond fund you own. Do not guess. Look at the fund fact sheet. A duration around 5 or 6 means the fund can move meaningfully when rates change. A duration above 10 can be very sensitive. Anything above 15 may behave far more aggressively than most people expect from a safe investment. Second, match the bond to the timeline. Money needed soon should not be exposed to long-duration risk. Money needed in 6 months has a different job than money meant for 20 years from now. The mistake is not owning bonds. The mistake is using the wrong bond for the wrong purpose. Third, compare your cash yield. Check what your bank pays. Then compare it with Treasury bills, money market funds, CDs, and high-yield savings accounts. Do not chase the highest number blindly. Look at insurance, liquidity, taxes, fees, and withdrawal restrictions. But don't let your money sit asleep simply because checking the rate feels boring. Fourth, watch the 10-year Treasury. You do not need to trade it. You do not need to predict every move, but knowing the direction helps. When the 10-year climbs, mortgages and borrowing costs usually become more painful. When it falls sharply, investors may be preparing for weaker growth. Think of it as the economy's check engine light. Fifth, never confuse a high yield with a safe yield. A bond paying 9% is not automatically better than one paying 4%. Sometimes the extra yield is opportunity. Sometimes it's a warning label. The market is offering more income because it sees more risk. That's the exchange. And that's the lesson. Bonds are not boring. Bonds are honest. They reveal the price of money. They show how much investors trust borrowers. They explain why mortgages rise. They expose stress inside companies. They shape stock valuations. They decide how much income cash can earn. They influence the safe side of retirement accounts. And they warn when the economy may be shifting. Most people ignore bonds because bonds are not flashy. No viral CEO, no meme stock energy, no overnight millionaire fantasy. But underneath the noise, bonds create the gravity of finance. You can ignore gravity, but gravity still controls the fall. A 1-point rate move can add nearly $100,000 to a mortgage. A rate shock can damage the defensive side of a retirement portfolio. A weak savings yield can cost thousands over time. A widening credit spread can warn about corporate stress. An inverted yield curve can signal economic trouble before most people feel it. So if you understand bonds, you understand the price of money. And once the price of money makes sense, the entire financial system becomes easier to read. Mortgages make more sense. Savings accounts make more sense. Stock valuations make more sense. Retirement losses make more sense. Corporate layoffs make more sense. Government debt makes more sense. The bond market is not separate from your life. It's underneath it. So before your next major money decision, ask yourself, where are rates? What is the yield? How long is the duration? Who is taking the risk? And what is the bond market already signaling? Because money rarely moves without a reason. Most people just never learn where to look. If this video helped you finally understand bonds, hit like, subscribe to the channel, and comment below, I understand the price of money. And remember this, the people who understand bonds are not necessarily smarter than everyone else. They simply stopped pretending the boring part of finance didn't matter.